Welcome back to Stock Spotlight, where we usually dive deep into one company. Today, we're doing something a little different because I want to talk about alternatives. And let me start with this. I used to be 100% equities. No bonds, no gold, just the market and some factor tilts. Then came 2022. Stocks dropped, bonds dropped, everything fell together. And I realized that even though I had diversification within equities, I didn't have resilience beyond them. That led me on a journey to rethink how I build a portfolio that can not only grow, but survive punches. This isn't about chasing alpha, it's about staying in the game long enough to let compounding do its work. Before we dive into the tools, let me start with something I wish I had truly internalized sooner. It's not just about what you earn, it's about what you endure to earn it. Imagine two portfolios. One grows at 7% per year with a 20% max drawdown. The other grows at 9 to 10% a year, but with a gut-wrenching 50% max drawdown. Same destination? Maybe, but only one of those lets you sleep at night and stay invested through the storm. Most investors don't fail because of bad returns. They fail because of painful volatility. That's why I focus on risk-adjusted returns. Because smoother journeys make it easier to stay the course, and the longer you stay in, the more powerful compounding becomes. Alternatives don't always beat the market, but that's not their job. Their job is to help you survive the worst days so you can be around for the best ones. Remember, a 50% drawdown requires a 100% gain just to break even. The less you lose, the faster you recover, and the more you compound. Risk-adjusted metrics like the Sharpe ratio, Sortino ratio, and max drawdown help you cut through the noise. They expose strategies that look great on paper, but fall apart under pressure. Because compounding is fragile, it breaks when panic takes over. That's why I own alternatives, not for alpha, but for defense, for durability, for staying power over full market cycles. We've all heard of the classic 60-40 portfolio, 60% stocks and 40% bonds. For decades, it worked. Stocks provided growth and bonds added stability. But in 2022, that entire structure broke down. Bonds didn't zig when stocks zagged. They zagged right along with them. Why? The Federal Reserve hiked interest rates at one of the fastest paces in history to fight inflation. As those interest rates rose, bond prices tanked. Meanwhile, equity valuations compressed under the weight of higher discount rates and economic uncertainty. So instead of bonds cushioning the blow, they actually amplified it. The S&P 500 fell about 18%, and the Bloomberg US Aggregate Bond Index dropped around 13%. So investors who thought they were diversified realized they were just holding two different flavors of risk. And when we zoom out beyond just 1 year, the long-term numbers tell the story too. From 1988 through March 2025, Mount St. Lucas, which owns and runs the KMLM ETF, has a pitch deck that shows a 60-40 portfolio return 9% annually with 9.3% volatility and a 32.5% max drawdown. Adding just 10% of managed futures to that mix, and the results improve significantly. We're now at a 9.5% return, lower volatility at 8.9%, and a smaller drawdown of 29.5%. Dial it further to a more balanced blend, 50% stocks, 40% bonds, 10% managed futures, and returns are still 9%, volatility at 7.6%, and drawdowns improve even more to 23.9%, which is nearly half that of stocks alone at drawdowns of 50.9% if you're 100% stocks. Now, to me, that's real resilience. Small tweaks to portfolio construction, not major overhauls, can drastically change how your portfolio behaves under pressure. It's why institutional allocators have leaned into these diversifiers for decades, and it's why I'm not chasing upside. I'm trying to build a glide path that's smoother, stronger, and more sleep-friendly. Alternatives just means anything that's not a traditional stock or bond. There's a universe of private alts, PE, VC, real estate, but most of those are locked up for years or require millions to access. That's not our lane. Our lane is liquid alts. the kind you can buy in an ETF today and sell tomorrow if you need to. These tools give us exposure to institutional style diversification without sacrificing liquidity. Today, I'm focusing on the alt trio that I believe in most for public accessible portfolios. That is managed futures, precious metals, mostly gold there, and long-short equity. Plus, a quick mention of tail risk hedging, even though it's not in my portfolio yet. Managed futures fall under the umbrella of commodity trading advisors, or CTAs, which are professional firms and models that use futures contracts across multiple asset classes to capture returns independent of the stock market. While trend following is the most well-known approach, where you go long rising assets and short falling ones, it's not the only game in town. Some funds incorporate carry strategies, which is profiting from the yield differential across futures contracts, momentum and macro filters that combine price trends with macroeconomic overlays, and sector and asset class diversification, which is choosing which markets to include or exclude dynamically. These strategies typically cover commodities like oil, wheat, copper, currencies like the euro, yen, or dollar, interest rates, both short and long, and sometimes equity indices as well. What makes them powerful? First, crisis alpha. They tend to perform well when both stocks and bonds are down. Diversification. They often have near zero or negative correlation to equities and bonds. Adaptability. They follow rules, not narratives, and they move faster than most humans can. And in 2022, managed futures were one of the few green spots while the rest of the 60-40 world melted. They're not about beating the stock market every year. Rather, they're about smoothing the ride, especially during inflationary shocks, rising rate regimes, or commodity volatility. I personally hold 3 managed future ETFs, and each brings a different engine under the hood. The first is DBMF. This fund mimics hedge fund managed futures exposure using regression-based modeling. It tracks how large institutional trend followers are positioned and adjusts its exposures weekly. It's not a pure trend follower. It's more of a hedge fund replication strategy that reacts to the consensus among the big players. Their expense ratio is 0.85%, and usually anything less than 1% is okay for me for this type of fund. I then also have KMLM, which is the purest trend follower in my lineup. It follows strict rules over 22 global futures contracts, spanning commodities, currencies, and interest rates, and there's no equity exposure in KMLM. Its performance is also tightly linked to how long-lasting trends are, so when the market chops sideways, it can lag, but when trends emerge, it will shine. The expense ratio is slightly higher at 0.90%. Then there's CTA, which is a hybrid. It uses trend signals, but also integrates carry and diversification filters across asset classes. This means that it can favor contracts with favorable roll yield, not just price momentum. It also adjusts sector exposure, which gives it an edge in volatile or sideways markets. And now it is less reactive than DBMF. It may be less pure than KMLM, but in my view, kind of a more balanced option of the 3. The expense ratio is also the lowest at 0.76%. One note on managed futures diversity. In 2022, one of the best years for managed futures, the range of performance across different strategies was over 65%. That means individual fund performance can vary widely, even when the category is winning. By combining DBMF's institutional mimicry, KMLM's trend purity, and CTA's multi-factor flexibility, I've built what I feel is a managed futures sleeve that's resilient across regimes. When I think of precious metals, I think of them as the portfolio anchor. Gold is the oldest form of money known to man. It's a store of value used by emperors, central banks, and today, ETFs. The thing is that it's not just a shiny relic of the past. It remains a powerful portfolio diversifier with staying power. But let's be clear, gold is not a productive asset. It doesn't generate cash flow, doesn't grow earnings, and doesn't innovate. So why own it? Because gold performs well in inflationary shocks, currency debasement, or money supply surges, negative real interest rate scenarios, and periods of market panic or financial crisis. In fact, during the worst 20 quarters for the S&P 500 since 1967, gold posted positive returns in 15 of them, often acting as a hedge when other assets sank. Here's the historical quirk that confuses many. Gold's long-term returns look unimpressive because for most of modern history, it wasn't allowed to rise in price. More specifically, until 1971, gold was bound by a fixed price regime, first under the classical gold standard, then Bretton Woods. For over 100 years, gold was artificially pegged, first at around $20 an ounce, and then at about $35 an ounce. From an investing lens, this means gold's return was literally 0% per year. Not due to market performance, though, but government mandate. Only after President Nixon ended the dollar's convertibility to gold in 1971 did it become a free-floating asset. That's when gold finally started trading like a true market asset. So any analysis that includes pre-1971 gold prices is deeply flawed. You're mixing an asset under price controls with one under market forces. There's a research paper online that models gold behavior post-1971 only, and returns are clear. A CAGR of 8.1% from 1971 to 2024, with gold moving in sync with monetary inflation and into money supply. Some argue that gold's post-1971 gains, especially from 1971 to around 1974, were a one-time event, a massive price catch-up after decades of price suppression. That's partly true. Gold quadrupled in real terms between 1971 and 1974. But what followed was decades of boom and bust cycles as gold reacted to real rates, monetary policy, and investor sentiment. So yes, the initial surge was unrepeatable, but the volatility and asymmetric upside of gold since then has remained a consistent feature, not a fluke. Gold's correlation to both stocks and bonds has historically been low, often hovering near zero. This low correlation gives it true diversification power. In multi-asset portfolios, a 2 to 10% gold allocation has been shown to improve Sharpe ratios, reduce maximum drawdowns, and add a hedge during market chaos. In fact, in a 60-40 portfolio, adding 10% gold reduced drawdowns by nearly 400 basis points across market crises like COVID, the Great Financial Crisis, and inflation shocks. I hold gold in two forms. One, an ETF form with GLDM. This is a low-cost, physically backed ETF. It's liquid and efficient and has a lower expense ratio than its bigger brother GLD. I also prefer GLDM's custodians, which are ICBC Standard Bank and JP Morgan Chase Bank, over GLD's HSBC. With that said, GLD has more AUM and might be more suitable for institutional investors. Expense ratio for GLDM is low at 10 basis points or 0.10%. I also have gold in physical coins. These are stored securely outside the financial system. I don't trade them and I just hold them quietly. I also want to say a quick word on silver. Silver shares many of gold's hedge properties, but it acts more like a hybrid between precious metal and industrial commodity. It's more volatile, more cyclical, and more dependent on industrial demand. I don't hold it as a core hedge, but some investors use it as a speculative satellite position alongside gold and trade it based on the gold to silver ratio. Bottom line, gold is not an alpha engine, but it is a portfolio stabilizer and psychological safety net. It performs best when other assets stumble and global trust erodes. For me, it's the one asset that helps me sleep better, especially when the world looks uncertain. Let's next dig into long-short equity, a category that often gets lumped in with hedge funds or misunderstood entirely. At its core, long-short equity is about relative bets. You go long the stocks you believe will outperform and short the ones you believe will underperform. Net exposure can vary, but in retail-friendly ETFs, it's usually market neutral or slightly tilted. That means the fund tries to balance its long and short positions so that overall exposure to the market's direction is minimal, and what matters would be the difference in performance between the two sides. In my case, I use BTAL, which is the AGFIQ US Market Neutral Anti-Beta ETF. And its strategy is long low beta or low volatility stocks and short high beta or high volatility stocks. This approach isn't about stock picking. It's a rules-based quant approach built on the low volatility anomaly, which is a paradox where low-risk stocks historically outperform the high-risk stocks on a risk-adjusted basis. Why does this anomaly persist? Because people love lottery tickets. Behavioral finance shows that investors consistently overpay for flashy, volatile, story-driven stocks. So when the market turns, BTAL shines. In 2020's COVID crash, it spiked. And in March and April 25, when the S&P 500 was down 10 to 15%, it was up 10 to 15%. Now, it will lag in bull markets where high beta leads, but that's a trade-off. BTAL is meant to be boring. It's a behavioral hedge that doesn't correlate with traditional bonds or gold. It gives you a different kind of diversification, rooted in relative performance within equities themselves, and for what I believe is a very reasonable adjusted expense ratio of 45 basis points or 0.45%. And this to me provides a clearer picture of the fund's core management fees than their top line reported expense ratio. Let's wrap up this alt category tour with tail risk hedging, the part of a portfolio you hope never activates. They're designed to lose small amounts of money consistently, like a premium, but spike dramatically in rare market crashes. Think of them as black swan insurance or the fire extinguisher in the corner. It's not there to impress guests, it's there when everything else fails. This means they're generally a drag on returns during normal periods, but can be lifesavers in extreme drawdowns. The most common tail risk tools include long volatility via VIX futures or VIX options, deep out-of-the-money puts on broad indices, and dynamic option overlays that tilt toward crash protection. One ETF that I explored is CAOS, ticker symbol CAOS. And this is from Alpha Architect, and I own their QMOM, and they have a lot of great ETFs. And this one has an expense ratio of 63 basis points or 0.63%. The objective of CAOS is to provide positive asymmetric returns during sharp market downturns. It uses protective puts and put spreads on the S&P 500 to hedge against major market drops. They also employ box spreads, which is a strategy that acts like synthetic cash to efficiently manage collateral and keep the option engine running smoothly. Their goal with all of this is ambitious, and it's to provide crisis protection while minimizing bleed in normal market conditions and achieving returns that are positive or uncorrelated even outside of panics. One reason I currently don't own CAOS is that, at least based on my research, it doesn't show negative beta or convexity of stocks. And let me break that down. Negative beta means an investment tends to go up when the stock market goes down. CAOS data on Portfolio Visualizer goes back to April 23, and it surprisingly has a 0.61 correlation to the S&P 500, while BTAL has a negative 0.66 correlation. Convexity means that the worse things get for stocks, the more that investment should gain, kind of like an airbag that inflates faster in a bigger crash. However, BTAL has shown more convexity historically when one analyzes the price charts. With CAOS, the idea is great, tail risk hedging with options. But in practice, the data so far doesn't show that sharp snapback or protection you'd hope for when markets really tank. But I'll say this, tail risk ETFs are evolving, and CAOS is one of the most innovative in the space. If newer strategy increased convexity or become more cost efficient, I'd reconsider. Let's talk about one of the least exciting but most important parts of alternative investing, taxes. These strategies can bring uncorrelated returns, but they also introduce some of the least tax-efficient structures in ETF land. Let's first talk about managed futures and the 60-40 rule. Most managed futures ETFs, like DBMF, KMLM, and CTA, are structured as commodity pools under IRS Section 1256. That means that 60% of gains are taxed as long-term capital gains, max 15%, and 40% of gains are taxed as short-term capital gains, up to 35%. And this is regardless of how long you hold them. That's helpful for active traders, but for long-term investors in taxable accounts, it creates a tax drag that's easy to overlook. According to Morningstar, 17% of profits are lost to taxes with KMLM. That's 19% for DBMF and 25% for CTA. Why the difference? CTA, for example, uses a blend of futures contracts, including interest rate futures, which are taxed under the 60/40 rule, and commodity contracts, where gains are taxed as ordinary income. On top of all this, these ETFs use T-bills as collateral, and that interest income is also taxed as ordinary income. What about gold? Gold ETFs like GLDM are taxed as collectibles under IRS rules. That means they don't qualify for long-term capital gains treatment. Yes, the maximum collectible rate is 28%, but it's not a flat rate. It's a cap, not a guarantee. Your actual tax rate on gold gains depends on your bracket, so most people will pay somewhere between 10 and 28%. Also worth noting, no interest or dividends means no forced distributions. Holding gold ETFs in IRAs eliminates the collectible tax issue entirely. You can offset gold gains and losses with capital losses and gains elsewhere. What you can't do is offset ordinary income from a business or salary using gold losses unless carried forward under capital loss rules. As one tax guide summarized it, gold can be tax efficient when handled properly, especially when rebalancing and with careful location. So now where do I hold my alts and why? I've structured my alternative holdings intentionally to minimize tax drag. KMLM and CTA are held in my IRA, where tax inefficient strategies like managed futures can operate freely without triggering annual tax consequences. That's ideal for funds that use futures and T-bill collateral. DBMF, BTAL, and GLDM are currently in my individual or taxable account, mainly because I've had more liquidity available there, and my current job's 401k money is tied up in Fidelity. But here's my plan. The next time I switch jobs or gain rollover flexibility, I plan to move some combination of GLDM, DBMF, and BTAL into IRA accounts to reduce that tax drag. I'll likely keep one managed future account in my taxable for capital gains offsetting purposes. So now let's put it all together. With all of these moving parts, here's how I simplify my approach. My portfolio rests on 3 legs. The first is stocks. This is for long-term growth and compounding and includes both individual stocks and factor-based ETFs. Second, alternatives, and these are for resilience and crisis alpha. And third, cash, for flexibility and dry powder. And cash balance is anywhere between 0 and a very small percentage, usually no more than 5%. I don't currently own bonds at my life stage, but I am aware of research on the diversification benefits of having long-term treasury bonds like a VGLT in a diversified portfolio, so I'm certainly open to owning that or a similar ETF in the future. Here's how I break down my alternative sleeve, which is about 17% of my total portfolio. I have 10% into managed futures, split among DBMF, KMLM, and CTA. I have 5% in precious metals, which is mostly GLDM, and some physical gold. I then have 2% into long-short equity, and that is in BTAL. Now in closing, let me leave you with this. If the market drops 30% tomorrow, what in your portfolio helps you sleep at night? Alternatives and precious metals won't double your money overnight, but they might stop you from making a panic decision at the bottom of a bear market. In a world where correlations break and volatility returns, resilience is no longer optional. It's your edge, and they don't have to be the star of the show to be a difference maker. If this helped reframe how you think about risk, resilience, or portfolio design, let me know on X and share it with someone who's still 100% stocks. See you in early August for a new company deep dive on the trade desk, ticker symbol TTD. Until then, stay diversified and keep compounding.